Hello everyone, welcome to the 51st episode of me learning how to trade in Forex. So in the last video we went through what the hybrid model used by Forex brokers are, basically a combination of both A book execution and B book execution. Customers are profiled according to whether they're profitable or not. So profitable customers go to A book, whereas unprofitable customers go to B book. Yeah, most of the brokers use hybrid approach, and now we're currently doing C-book, how Forex brokers manage their risk. So, C-book, how Forex brokers manage their risk. Date is the 18th/02/2024. Okay. Aside from the Forex brokers who A-book or B-book, you might also come across the term C-book. C-book is a term that is used to describe risk management strategies that Forex brokers and contract for difference providers use that are supposedly different from the A-book or B-book. In our opinion, C-book is just a marketing jargon. It's not really a different approach that brokers use to manage risk. It's more of a vague term to describe variations or tweaks of A-book and C-book execution. As you'll see, C-book execution isn't really used by the brokers to manage risk, but to try and make more money for itself. These execution methods are also considered controversial, and it's questionable whether Forex brokers should be doing them. We'll leave it up for you to be the judge. We'll cover three forms of C-booking: partial hedging, over hedging, and reverse hedging. C-book. Execution isn't really used by broker to manage risk, but to try and make more money for itself. Three forms of C booking: partial hedging, over hedging, reverse hedging. So, partial hedging. The most common form of C-book execution is the partial hedging of a customer's order. A broker can hedge market risk in part and not in its entirety. This will reduce, but not eliminate, adverse price movements to the position being hedged. The risk that remains unhedged, also known as residual risk, gives the broker the opportunity to profit if the price moves in its favour. Think of this risk management strategy as partial A-book and partial B-book. Basically, the broker has A-booked a certain percentage of its risk and has B-booked the rest. So, A books a certain percentage of its risk and B books the rest. Let's look at an example where the broker hedges 50% of a customer's position. So got Elsa, the Donny back again, with 100,000 euro USD at 1.2001 to 1.2001, buying from the broker. Broker sells it back to Elsa at 1.2001. I think there's a typo here again. The broker buys 500,000, which is half of that. Euro USD rises. Elsa's profit makes 10,000. broker loses 4,900, and the liquidity provider also loses 5,100. Elsa opens a long Euro USD position at 1.2001. Her position size is 1 million units or 10 standard lots. This means a 1 pip move equals $100. The broker hedges 50% of the risk by opening a long 500,000 Euro USD position with a liquidity provider at 1.2. If it had gone long the entire 100,000 units, this would be a considered A book since 100% of the position is hedged. Euro USD rises in price. Elsa wants to take profit and exits a trade at 1.2101, resulting in a gain of 100 pips or $10,000. For the broker, this means a $10,000 loss. If the broker had just B-booked Elsa's trade, it would have had to eat the entire loss, but fortunately it hedged part of Elsa's trade. Whilst the hedge trade resulted in a gain of 102 pips, since the position size was 500,000, half of a million, the profit was 5,100. This profit made from the liquidity provider helped reduce some of the losses from Elsa's trade, so the net loss was 4,900 instead of the full 10,000. Conversely, if the Euro USD fell, the profits of the broker against Elsa would be reduced by the losses incurred from hedging. So the broker would gain more? Yeah, the broker would gain more profit here. In this example, Elsa opens a long Euro USD position at 1.2001. Brokers hedges 50% of the risk by opening a long 500,000 Euro USD position with a liquidity provider at 1.2. Euro USD falls in price. Elsa's stop loss is hit and her trade is exited at 1.1951, resulting in a loss of 50 pips or $5,000. For the broker, this means a $5,000 gain. If the broker just B-booked Elsa's trade, it would have kept all this profit, but it didn't. It hedged part of Elsa's trade. The hedge trade resulted in a loss of 48 pips since the position size was 500,000. The loss was $2,400. This loss suffered from a liquidity provider helped reduce some of the profit from Elsa's trade, so the net profit was 2,600 instead of the full 5,000. So far, you've seen how the broker can fully hedge 100% against the customer's position, or known as A book, and you've seen how the broker can partially hedge more than 100%, or that should be less than 100%, shouldn't it? It should be the other way around. Oh no, that is the right way. Less than 100% against the customer's position, known as C book. Overhedge. C booking is not limited to partial hedging. Another variant of C booking is when a broker can also choose to overhedge, meaning it can hedge more than 100% of the customer's position. Hedging more than 100% of a customer's position. For example, instead of a hedge trade that covers 100%, it can choose to hedge 110%. Rather than C book, a more accurate name will probably be A book plus. Why would the broker want to do this? If the broker thinks the customer's trade will make a profit, it can ride along with the customer and make some extra profits. Ah, right, okay. Yeah. These, I'm not going to try to read that, to be honest. Elsa opens a long 1 million Euro USD position at 1.2001, which means the broker is now short 1 million Euro USD. Here, the broker can decide to not hedge B book, partially hedge C book, 100% hedge A book, more than 100% hedge C book. The broker's profiled Elsa as an informed trader and chooses option number 4. It hedges 110% of the risk. It goes long 1 mil 100,000 USD with a liquidity provider at 1.2. If it A booked the trade, it would go on 1 mil, gone long 1 mil. Instead, it went long 100,000 plus additional. I went long what? Plus additional 100,000 units, or the equivalent of 110% Elsa's position size. Elsa's turns out right and Euro USD rises. She exits a trade for a gain of 100 pips or $10,000. Obviously, this means the broker has a loss of 10,000. But notice its profit and loss with the liquidity provider. Since the broker overhedged and had a bigger position size against the liquidity provider, its profit from the liquidity provider exceeded its loss from ELSA. The broker was able to juice its profits. This overhedging strategy is not without risks though. Let's see what happens when the customer loses. In this scenario, EUR/USD falls and ELSA exits a trade at a loss of 10,000. Obviously, this means the broker has a gain of 10,000. But notice its profit and loss with the liquidity provider. Since the broker overhedged and has a bigger position size against the liquidity provider, its loss from liquidity provider exceeds its profit from ELSA. This is the trade-off if the broker's hedge exceeds 100%. It exposes itself to greater loss if the customer ends up wrong. However, can expose itself to greater loss if the customer ends up wrong. So this is kind of, I guess, using leverage, isn't it, from the broker's point of view, because they're trying to trade more than they can handle, if that makes sense. So it's like a double-edged sword where if the customer makes a profit, you make extra profit as well. But if the customer loses the trade, then you're going to make extra loss as well. So yeah, reverse hedge. Another variant of C-booking is when a broker reverse hedges a customer's trade, either partially or completely. This practice is based on the assumption that a customer trades so poorly it's possible to make money by not only B-booking the position, but to add on to the B-booked position. Rather than another variant of C-book, a more accurate name would probably be B-book plus. Reverse hedges are either partially complete this practice on this mention. Based on the assumption that a customer trades so poorly it's possible to make money by not only B-booking the position, but to add onto the B booked position. Rather than another variant of C-book, this more accurate name would probably be B-book plus. Basically, the broker does not even try to hedge or transfer market risk. It purposefully takes on more market risk. When a broker chooses to reverse hedge a customer's trade completely, it's basically increasing its B-book risk. So ELSA goes long 101 mil EUR/USD at 1.2001. Since the broker is ELSA's counterparty, it is now short 1 mil EUR/USD. The broker is now exposed to market risk if EUR/USD rises. If we stop here, this would be B-book execution. Does the broker wish to A-book the trade and completely hedge? Nope. It has profiled ELSA as an unprofitable trader, so instead of completely or even partially hedging with an LP, it decides to reverse hedge 50% of the trade. So instead of going long EUR/USD, which is what it would have done to cover its market exposure, it goes short 500,000 units of a liquidity provider. Buy. Remember, it is already short 1 mil against units against this customer, but added even more risk exposure with an additional 500,000 units against the liquidity provider. In this scenario, the broker turned out correct. Euro USD did fall. Elsa exited the trade with a loss, which translates to a gain for a broker, but its trade with the liquidity provider also results in a gain. As long as the broker chooses correctly which trade to reverse hedge, this strategy can be very lucrative. But if it goes wrong, the risk it exposed itself to is even greater than if it had B-booked the trade and would have resulted in much bigger losses. Here's an example where it doesn't go well for the broker. Elsa goes long 1 mil USD 1.201 since broker Yep short. Instead of going long, which is what we've done to cover exposed short, remember it's already short, added even more. Euro USD rises. Elsa exits the trade with a gain, which translates to a loss to the broker. If the broker had A-booked and opened a hedge trade with the L liquidity provider, it would have had a gain from the liquidity provider and to offset its loss with Elsa. Instead, its trade with the liquidity broker also resulted in a loss. So double loss. So I see what's they mean when it says different approach to manage risk. Not really a different approach. It's more vague to describe various tweaks of A-book, but to try and make more money by itself. I see what they mean by that. So partial hedge, A-book a percentage, then B-book the rest. And then overhedging, riding onto the customer's trade if they think it's a profitable customer, just basically copying but then adding on their own little bit of extra cash in there. Reverse hedge, so it gets more riskier as you go on basically. Okay, cool. Know your Forex broker's hedging policy. For every Forex broker, each and every trade entered into by its customers represent exposure to market risk. Market risk is a risk of a loss in the position caused by adverse price movements. Because the Forex broker is always a counterparty to your trades, it may decide to execute your trades internally or hedge your trades externally. The term hedging refers to the process where a Forex broker reduces market risk exposure by entering into a parallel transaction with another entity, a liquidity provider. The process where a Forex broker reduces market risk by entering into a parallel transaction with another entity, which is the liquidity provider. Rather than hedge every single trade, the most popular hedging policy these days is for a broker to hedge customers' exposure on a net basis. This is where incoming trades are internalized before any trades are externally hedged. This hedging policy gives aggregate customer exposure the opportunity to offset itself before being hedged in the underlying institutional FX market. When one customer trades in one direction and another trades in the equal and opposite direction, the market risk exposure is offset, so cancelled out basically. However, when customers trade in the same direction, market risks build up for the broker. This risk is then reduced by hedging in the underlying market. Risk limits, governed and assessed by the broker's overall risk management policies, determine the maximum market risk that a forex broker can undertake. To make these hedges, the forex broker deposits collateral margin with a counterparty, similar to how you post margin with a forex broker. Overall risk management. This is important to know because posting margin means the broker has to put up cash margin with liquidity providers they trade with. If one of these liquidity providers were to fail and not be able to return the broker's margin, the broker may end up in a perilous financial position where it may not be able to fulfill its financial obligations with its customers, like you. This is why when selecting the hedging counterparties, liquidity providers, the broker considers the competitive quotes offered, credit rating, the efficiency of service, reliability of technology, reputation and financial standing. For smaller brokers, they may not be able to choose their liquidity providers as they solely rely on the service of a prime to hedge their trades and are limited to the liquidity providers that the prime of prime grants the broker access to. Unless stated by a broker, it is important to note that a broker's hedging practice may not totally eliminate risks to its customers. Ask your broker for a written copy of his hedging policy. For a written copy of its hedging. The hedging policy outlines procedures it adopts to manage its exposure to market risk and discloses the counterparties with which it transacts to hedge that risk. To manage market risk and discloses the counterparties with which it transacts to hedge that risk. By asking for this, it will provide you an insight into its hedging procedures so that you are better informed to assess the counterparty risk in dealing with your broker. Remember, if your broker goes bust, your money goes down with it. We've discussed the perils of a counterparty risk in detail in a previous lesson. Where are you trading? If your broker doesn't want to disclose any of these details, it might be a good time to find a broker who will. The only way a broker should earn your trust is through transparency. Be suspicious of any broker who isn't transparent with its hedging policy, which should detail not only its hedging practices, but disclose its hedging counterparties, its liquidity providers. Summary: we have explored the basic mechanics of how brokers hedge and manage market risk. We've introduced a large number of risk management concepts like A-book, B-book and different variants of C-book that retail FX and CFD trading platforms may use. Due to the high levels of ambiguity at which brokers tend to operate, we hope we have shed some light on what happens behind the scenes regarding how they manage their risk to make money. Now you know that all retail Forex brokers take the opposite side of your trades. Your broker is a counterparty to all of your trades. When a broker executes your trade, it can offset your trade internally with another customer's trade, internalization, offset your trade externally with a liquidity provider. If this is done before it confirms your trade, it is known as pre-hedging or straight-through process. If this is done after it confirms your trade, this is known as post-hedging, A-book. Not offset at all and accept market risk, so B-book. Partially offset your trade externally with a liquidity provider and B-book the rest, C-book. Offset more than 100% of the risk of your trades externally with a liquidity provider, C-book. Not offset at all and accept market risk and also reverse hedge externally with a liquidity provider, C-book. So this is a partial hedge, this is over hedge, and this is reverse hedge. While we covered multiple methods used by brokers to manage their risk, it's important to know that every broker is different and each will adopt their own practice that suits their risk appetite. Hedging is considered expensive because brokers want to maximize profits. They prefer to hedge as little as possible. Risk management practices also continue to evolve and there is no standard policy for how brokers manage their risk. Traders may have some reservations about brokers who B-book and think they should only trade brokers A-book, but what ultimately matters is accurate pricing and the quality of execution you receive on your orders. Accurate pricing and the quality of execution you receive on your orders. Accurate pricing and the quality of execution you receive on your orders are very important factors. Okay, where does a Forex broker's price come from? Where does the Forex broker's price come from? 1802-24. When trading Forex, you are speculating on the future direction of currencies, taking either a long buy or short sell position, depending on whether you think a currency pair's exchange rate will go up or down. Specifically, you seek to profit from fluctuations in exchange rates between currencies, betting on whether one currency's value, like the Japanese yen, will go up or down in relation to another, such as the Australian dollar. Price movements in the Forex market are triggered by currencies either strengthening, price appreciation, or weakening, price depreciation. Your ability to open and close trades is limited to the prices that your Forex broker offers to you, and there is no other market for these trades. So now the question is, how do you know the prices that you see on your broker's trading platform are an accurate reflection of what's happening in the real institutional Forex markets? Let's review one part of the earlier story between Batman and Spider-Man. The game works like this. Try to guess if the GBP USD exchange rate will go up or down. Let's say the current exchange rate is 1.4. Do you think it will go up or down? Notice how Spider-Man just seems to make up a price for GBP USD. Fortunately, Batman didn't just take Spider-Man's word for it and use his bat phone to verify the price of a third-party source. If you're not familiar with the story above, this means you haven't read our earlier lesson on how Forex brokers kind of work. It's highly recommended that you read this lesson first. Like Batman, you should wonder about the same thing regarding Forex brokers. Where do the Forex broker's price come from? Are the prices accurate? For any given currency pair, your Forex broker will quote you two prices: a higher price ask, at which you can buy, go long; a lower price bid, at which you can sell, go short. Collectively, the ask and bid prices are referred to as the Forex broker's price to you. Higher price ask, which you can buy long; Forex brokers offer you two prices. Higher price, at which you can buy; lower price bid, at which you can sell, go short. So we've got one here: sell, buy. So buy is if you think the price is going to go rise up; sell if you think the price is going to drop. The difference between the low and the high price is known as the spread. Yep. So in this case the spread is 1.2 because 264 minus 252, that's 12, which is 1.2. You can see these quotes on your trading platform. Well, it's not even 1.2, but it's that minus that, I think. You can see these quotes on your trading platform or customer terminal. These quotes displayed are known as the price stream. Are known as a price stream. So you've got the price stream here, the bid, aka the sell, and the ask, the buy price. But where do these prices come from? Does the Forex broker just make them up? It's possible, but highly unlikely. Now you might be thinking, huh? It's possible, but did you know that your Forex broker may show any price it wishes? As we covered in a previous lesson about the FX market, retail traders can't trade in institutional interbank FX markets. We're deemed uncreditworthy, too poor. So, if you want to speculate on currency exchange rates, you need to find a retail Forex broker. The Forex broker makes a Forex market for you to trade in. This is either in the form of contract for differences if you're outside of the US, or rolling spot FX contracts if you're in the US, which together can simply be called the retail FX contracts. These contracts involve only two parties, you and the Forex broker. And since these contracts are created by the Forex broker, it can technically quote whatever bid and ask price it wants, and it's up to you to choose whether you'll trade at those prices. How and where a Forex broker sources its price is totally up to its discretion. On its trading platform, it may show you prices derived from outside sources, or it may not. This means that prices offered by your Forex broker may or may not reflect prices available elsewhere, such as from another Forex broker. Why is this the case? Shouldn't the prices quoted by the Forex broker be identical to the prices in an underlying institutional FX market? And there lies the problem. In the FX market, for each currency pair, there is no such thing as one market price. The FX market is what's called an over-the-counter or OTC market. In an OTC market, there is no centralized place where all the market participants gather and can see the same single market price. How pricing works on exchanges. To help you better understand why it's important to understand the significance of the FX market being an over-the-counter market, let's compare this to an exchange-based market like the US stock market. One of the founding principles of an exchange-based market is it must offer fair and equal access to all participants. Exchange publish quotes for everyone to see and trade. To understand this better, let's quickly look at how pricing works in the US stock exchanges. When a trade occurs, an exchange reports the trade to a consolidated data feed called the SIP, Securities Information Processor, which disseminates the data. For example, when the NYSE executes a trade to buy Apple shares, it reports the trade to a SIP. In addition to trades, the best bid and ask prices on different trading venues are shared with the public to the SIP. The SIP then combines all the quotes to determine the National Best Bid and Offer, NBBO. This data consolidation takes place very quickly. The average time it takes for SIPs to gather, consolidate, and disseminate a trade report is around 17 microseconds, millionth of a second. To put that into perspective, a human blink of an eye takes 100 milliseconds, a tenth of a second, or 100,000 microseconds. This means that pricing data updates in less than 0.017% of the time it takes to blink an eye. The NBBO is extremely important as it tells traders the price at which they all can buy and sell at that moment. In 2005, the SEC passed the Regulation National Market System, known as the Reg NMS, requiring brokers to obtain best execution for all orders within the NBBO. Basically, Reg NMS obligates brokers to route orders to the venue offering the best price, which is based on the NBBO. The advantage of having consolidated data in the US stock market is that the NBBO provides unambiguous reference points that allow all traders to assess whether they got fair pricing. The MBBO allows everyone to know the best bid and offer for every exchange-listed stock, regardless of what venue they're posted on, all less than a millisecond after the quotes change. This provides fair and equal pricing for all traders, both large and small. All traders are protected by the prices that the exchange shows because every trade must occur at prices no worse than the MBBO at the time the trade was executed. Okay, how pricing works in the Forex market. In an exchange-based market, there is a single market that allows everyone to all interact at the same prices. In contrast, the FX market does not operate in a centralized public exchange. There is no single market, which means there is no single market price. There is no equivalent of a data feed like SIP that consolidates all trades that occur and the best bid-ask prices that are quoted. This means that the Forex market does not have the equivalent of an MBBO for each currency pair that would provide an ambiguous reference price that every Forex broker would have to adhere to. How retail Forex brokers should source their prices. Reputable Forex brokers will base their price on the price of other FX participants, usually banks and other non-bank financial institutions, from the institutional FX market. So, reputable will base their price on the of other FX participants. These market participants are known as liquidity providers. A group of liquidity providers is known as the liquidity pool. Group of providers are known as a liquidity pool. It is these prices that the Forex brokers use as a reference price of an underlying currency pair, or at least should be using. As mentioned earlier, a Forex broker will quote you two different prices for a currency pair, the bid and ask price. You see these quotes on your trading platform or customer terminal. These quotes arriving are known as the price stream. The price that you see is based on the price that a broker obtains from these liquidity providers. So, retail trader, that's us. Retail trader orders with a Forex broker. The retail Forex broker then hedges order with a liquidity provider, that's optional, right? Retail traders order with a Forex broker, yep. Price stream from Forex broker, yep. Quotes from multiple liquidity providers, institutional level, retail level. So, I think the order goes the blue arrow, which is price stream from Forex broker, then the retail traders order with the Forex broker, the retail, oh no, at first it was the purple one, isn't it? Quotes from multiple liquidity providers, and then it can provide the price stream to the Forex broker, retail trader. The retail trader places the order, and then the Forex broker can either hedge the order of the liquidity provider, which is optional. The broker has the pool of multiple liquidity providers from which it receives pricing for the various currency pair it offers. The Forex broker aggregates or collects these prices in real time and finds the best available bid and ask price. Both prices do not necessarily have to come from the same liquidity provider. For example, the best available bid price may come from one liquidity provider, while the best available ask price may come from another liquidity provider. The aggregated prices are fed into a pricing engine which streams prices, your price stream, to your trading platform. The price that you will see usually have a markup added unless you're paying commission. Theoretically, this should be an automated process where the broker has neither control over the selection of the best available price from the pool of liquidity providers, nor can it manually intervene to alter any prices streamed from the trading platform, aside from adding a markup. Just because two traders use the same broker, it doesn't automatically mean they both see the same bid and ask prices in their price stream. Different customers may be quoted different prices. That's interesting. Different customers may be quoted different prices. It depends on how brokers profile their customers and if the price engine is configured to vary pricing by profile. This is known as price discrimination. Ask your broker if it price discriminates between customers. Price discriminates between customers. Liquidity providers. Every reputable forex broker displays to you their price based on what liquidity providers they have access to. What liquidity they have access to depends on their liquidity providers. Forex brokers who are large enough to have prime broker can access a mix of different liquidity providers such as Tier 1 banks, ECNs and aggregators. Most of the global FX liquidity is provided by large banks with dedicated FX departments and are referred to as Tier 1 liquidity providers. This Tier 1 group of liquidity providers is made up of names such as Bank of America, Barclays, BNP Paribas, Citi, Commerzbank, Credit Suisse, Deutsche Bank, Goldman Sachs, HSBC, JP Morgan, Nomura, Societe Generale and UBS. By connecting themselves to multiple liquidity providers, these larger forex brokers can improve their prices and offer their customers the best available bid and ask prices from among the liquidity providers. How? When multiple liquidity providers stream their bid and ask prices, the broker's price engine selects the best bid and ask price, which results in the best available spreads. Right. Theoretically, the collective trading volume selects the best bid buy price and then selects the best sell price. So the largest buy price, the smallest buy price and the largest sell price, and then you can have the largest difference, which is the largest spread. Theoretically, the collective trading volume of the broker's customers encourages price competition among the liquidity providers. Each liquidity provider is competing to be the forex broker's hedging counterparty, so this provides the leverage to demand better pricing. Having multiple liquidity providers is also important, especially during abnormal market conditions, such as during times of extreme volatility, when some liquidity providers may decide to widen the spreads or stop quoting prices altogether. For A-book brokers, this is crucial since their execution model is totally dependent on liquidity providers being available to provide quality liquidity even during volatile or illiquid market conditions. Smaller forex brokers source their pricing by connecting to an aggregate liquidity feed provided by Prime of Prime, and sometimes in conjunction with other prime non-bank liquidity providers, who are known as electronic market makers. Examples of electronic market makers that are active in the FX market are XTX Markets, Citadel Securities, Virtue Financial, Global Trading Systems, HTC Technologies and Jump Trading. Prime of Prime providers have prime broker relationships with major banks, which gives them the ability to aggregate prices from multiple liquidity providers and distribute them to smaller forex brokers. Do you see bank logos on forex brokers' website? If you see the logos of big banks, Barclays, Citi, UBS, etc., displayed on a retail forex broker's website, don't believe the hype. Due to their small size, most retail forex brokers don't have direct relationship with these Tier 1 liquidity providers. Only the largest forex brokers with prime broker relationships can claim this. The rest have to rely on Prime of Prime, and it is the Prime of Prime, not the broker, who should be displaying the bank logos. Be careful of price manipulation. Potential conflicts of interest arises from lack of transparency in the pricing of FX contracts. It is not always clear whether the pricing is actually linked to an underlying market, and it's hard to verify. Your Forex broker may establish its prices by offering quotes from a third-party price, but it is under no obligation to do so or to continue to do so. Some Forex brokers may even require their customers to acknowledge that the reference prices used to determine the value of underlying asset, e.g. currency pairs, may differ from the prices available in the market. As a consequence, traders often find it difficult to verify the accuracy of prices shown to them on the broker's trading platform. For example, you can see the prices on your trading platform that your broker quotes, but unless you also have the other trading platforms open from other brokers, it's hard to compare quotes. This makes any open or pending positions vulnerable to price manipulation. For example, traders have complained of Forex brokers altering prices at their own discretion to either cancel a winning trade, to avoid payout, or close trades to realize customer losses. Volatile market conditions provide the perfect opportunities for price manipulation and stop hunting, where a broker closes a trader's position to make profit for itself. If you place a stop loss or take profit orders, since the broker knows exactly where these orders are, you can manipulate this so-called market price to hit your stop loss or miss your take profit chance. This means the broker wins or avoids a loss. Whilst this practice is not as common as it once was, it still continues with shady brokers who operate in unregulated or minimally regulated jurisdictions. If a broker is under a regulatory jurisdiction with minimal or no transaction reporting requirements, it can be very hard to prove, which is why it still continues today. Another complaint involves brokers engaging in asymmetric slippage practices. Slippage refers to an instance where the price at which the order is executed differs from the price quoted for a market order, or the price requested for a stop loss or take profit orders. A huge amount of slippage can occur during breaking news or when major economic data reports released. A broker can introduce asymmetric slippage into order execution where, if price benefits a broker, it will execute, but if it doesn't, then the price is slipped and requoted with another price that favours the broker. And if the market moves where it benefits you, the broker won't execute order with the price improvements. How to make sure you get fair pricing. As retail traders, we expect that the price quotes will closely follow the underlying market, but how similar these prices are to the market depends on the Forex broker. Forex brokers adopt a degree of discretion in price setting, especially during periods of high market volatility. This use of discretion is what causes some retail Forex and CFD trading platforms to have an unclear and confusing pricing methodology. A pricing methodology process or procedure used by Forex broker to determine what prices is shown to the customers. There have been instances where customers of certain Forex brokers have filed formal complaints to regulatory agencies about unfair pricing practices. Examples of complaint include how the prices were not determined fairly and customers were shown prices that were not even close to the prevailing market price at the time of a trade was made, how the Forex broker unfairly exercised its own discretion to close up positions of its customers resulting in realized losses. The problem is that prices are not readily verifiable, as there is a lack of transparency surrounding the price process in which retail Forex brokers and CFD providers display prices to their customers. Here are some online resources that you can use to gauge how close the prices your Forex brokers offers to what others are offering. To gauge how close to what others. Integral OCX Trading View LMAX Exchange FXCM. I think we've been on this website before actually, FXCM, haven't we? Yeah, FXCM. Ah, we'll meet again. Okay, so that's good to know, FXCM. Remember, since the FX market is an over-the-counter market, there is no single price, so while prices may not exactly be the same, they should only deviate by a tiny bit, a pip or less, depending on the currency pair. How can you be sure you are getting the best pricing available and prices not being manipulated by your broker? If the broker claims that your trading prices directly sourced from a liquidity provider, can they provide you with evidence? Retail Forex and CFD trading platforms should be able to clearly explain how it determines their pricing, including platforms should be able to clearly explain how it determines their prices. This includes how it uses non-affiliated third-party liquidity providers to derive its prices, non-affiliated, how it uses independent externally verifiable price sources to ensure prices from the liquidity providers closely follow prevailing market prices, and externally verifiable price sources to ensure prices from liquidity providers closely follow prevailing market prices. How it applies any spread or markup. The pricing and spread should be set via price competition for multiple liquidity providers. But the pricing and spread should be set. But that's not all. Ask your broker how often they review the price providers. Ask how often they review their price providers. Brokers should be comparing the price provided by their liquidity providers against external price sources, both in real time for actual prices and at least on a weekly basis for average prices. Should be comparing the price provided by the liquidity providers against external price sources, both in real time for actual prices and weekly, and at least on a weekly basis for average prices. This helps to ensure that there aren't significantly deviations from the market prices in the pricing quoted to the customers. In case where the price is outside acceptable predetermined parameters, the broker should have systems in place where it is alerted immediately so it can investigate and take immediate action. Make sure to ask what these acceptable predetermined parameters are. Ask what acceptable parameters for when price is outside. Ask when the be alerted. Ask when the broker will be alerted if there is significant deviations from the market prices, and how it determines what this acceptable range is. Ask when the broker will be alerted if there is significant deviations from the market prices, and how it determines what this acceptable range is. Acceptable deviation ranges. Yeah, I think that makes sense. Make sure to ask what these acceptable predetermined parameters are. Yep. Lastly, the Forex broker should be able to provide you a written policy clearly explaining its pricing methodology. Ask your broker for a written policy clearly explaining its price methodology on how it opens and closes CFDs or rolling spot FX contracts honestly and fairly. How it opens and closes CFDs honestly and fairly. The policy should also cover any circumstances under which its prices will deviate from its stated pricing methodology. So the policy should also cover any circumstances under which its prices will deviate from its stated pricing methodology. The policy should also cover any circumstances under which its prices will deviate from its stated pricing policy. If the broker can't provide you with their pricing methodology, look for the one who can. Okay, that was another long session, but lots of information learnt, which is very good. So I'm going to end this episode here. In the next video we're going to be doing what is the Forex broker's order execution quality. So very nice. Thank you guys for watching this episode, and I will see you guys next time. Peace.